Hey folks, and welcome to this video. Today we're going to spend a little bit of time talking about liquidity, exploration, exploitation, whatever you want to call it. We're going to talk about what it is, why it's important, and what it looks like on the price chart. And during this presentation we're going to talk a little bit about the concept of thick liquidity and thin liquidity, and what thin liquid or illiquid markets look like, and what liquid markets look like, because this is pretty important stuff. Okay, there's the agenda. We'll just jump over that. So what is liquidity? Liquidity is essentially being able to buy something or sell something without affecting the price. Okay, and it could, let's say gold, for example. If I can buy gold, if I can buy $50,000 worth of gold, and my purchase of that asset doesn't cause the price to move at all, then it's a liquid market. If I want to buy $1 billion worth of gold and my transaction doesn't cause the price of gold to change, then it's a liquid market. If I, on the other hand, buy another asset, for example, some new cryptocurrency, and my $100 purchase causes the price of the asset to increase by 4,000%, well, that's a very illiquid asset. And the reason it's illiquid means that whatever is for sale, there is not a lot of it. And so with my $100 transaction, I can accumulate, I can buy all of the accumulation or a lot of it to a degree that it increases the price, because my demand for it causes the price of the asset to increase. And if we look at an example of liquid assets, we can consider, gold is a really good example of a liquid asset. We have the Euro American dollar, the dollar, Japanese yen, and there are many other things that are liquid, oil and so on and so forth. Then we have illiquid assets. We have our small cap crypto example. We have collectible wines and watches and etc. I have a friend who collects very rare and very expensive watches because that's how he wishes to store his wealth. Even though he has a watch that's worth 36,000 euros, it's not sure that he can sell it, because you have to find the counterparty to buy it from you. Okay, so what is it that's making a market move? Well, a market moves based on the presence of willing buyers and sellers. If we do not have people who are showing intent on buying or selling, then the market will not really move. And so willing buying and selling, if I'm willing to buy an asset, then I have to show intention, and my intention to buy will typically be an order that I put into the marketplace. Okay, and once my order is filled, my buying may or may not affect the price of the asset, depending on the time of the day and the liquidity of the asset during the time that my transaction is filled. And as a result, you can buy an asset during an illiquid time of the day, and this can cause the price of the asset to increase. Okay, and then you'll see these little patterns. You'll see demand, which is where my order went in, and then a departure in price. For an illiquid market, the price increased. Okay, and you can see supply as well, and then this is where the opposite happens, where you have supply and something is sold, and this pushing of supply back into the marketplace reduces its price, and then you'll see a decline lower. Okay, so this intention, as I mentioned, is in the form of unfilled orders. And this is kind of counterintuitive just a little bit, because if you look at a price chart, you can't see where people have orders. You can't see people's intent to buy or sell. What you can see is what has already happened. You can see the effect of people's or institutions buying and selling has on the price of the asset. Okay, so what does a price chart show us? Well, it's showing us filled orders. It's showing us the patterns that result of buying and selling the asset. You can see where buy and sell zones are located in the market. And a buy and a sell zone is essentially an attractive price to buy or sell an asset. You can see historical areas of value where you have buying and selling. Rather, you can see historical agreement in price, which is typically a low volume period of time where buying and selling happens almost equally, and the price of the asset just moves up and down in a channel. Okay, and this is referred to as value. You can also see where we have discount prices and expensive prices or premium prices. So when price is typically really low, it's a discount price, and this is an obvious place for people to begin to buy. And this in the financial markets is no different than in normal commodities like coconuts or kombucha. These are things that are quite relative to me in Bali, or bintang, which is beer, or whatever else. If the price of it, if a large bottle of bintang goes to 25,000 rupiah, I mean that's a really good price. That's a discount price. But if it goes above 40, then that's a pretty expensive price, and I wouldn't buy it. But if it went below 30, or yeah, if it goes below 30, I mean that's a good price, because currently the agreed price for a half a liter bottle of bintang at my kiosk just down the road is 33,000 rupiah. So if it goes under that, then it's a discount price, and it'll attract buyers of bintang out of the sidelines, and they will buy more bintang. Okay. Yeah, and you can see here, I mean, the last comment here, where supply and demand are met. This is where you have just like an equal, nice and smooth, fairly low volume period of time where buying and selling happens efficiently, and it causes sideways price movement, also known as accumulation, distribution. But it's value. People are happily to transact at these prices, both to buy and to sell. And so currently, if I use the bintang example, my supermarket sells me bintang for 33,000 rupiah, and I'm pleased paying that price. And so every other day I'll go to my kiosk and I'll buy myself a bottle of bintang, and I'm going to share with my wife. Okay? And so they're selling to me, and I'm happy to buy the bintang for 35,000. And the same is exactly applicable to the financial markets. Okay, so if we consider liquidity, willing buying and selling in a marketplace, we typically will have a thick side of the market, and we have a thin side of the market. Okay, and the thin side of the market is typically a side of the market where people are not terribly happy transacting. Okay, so there's very little exposure to that side of the market. Okay, and the thick side of the market is that people are happy to transact here. So people are going to buy in greater volume the lower price goes. So if we draw something like this is a price ladder, what you can see here, where the lower the price goes, I mean the bigger the order goes. So they're quite small, a little bit bigger. They're not here, but just imagine they are, and it gets bigger, and so the volume increases. Discount prices, wow, this is really cheap, and so people are willing to buy more. And so if bintang is on sale, let's say bintang goes to let's say it goes to 10,000 rupiah per bottle, then I'll probably buy 24 bintang, and I'll keep them somewhere in my house, and then I've gotten the smoking deal. And so you can see if bintang is down here and it's 10,000 rupiah per bintang, I'm going to buy more of them, and so my order for bintang is going to be bigger. Where up here, if it's 40 and I haven't had a bintang in 2 weeks, then maybe I'm going to buy, well, that's pretty high price. Maybe I'm only going to buy 2. Okay, but down here, because it's so cheap, I'm going to buy maybe 15. Okay, and the exact same applies in the financial markets, where thin liquidity here, there's a very small willingness to buy up here, there's a very high willingness to buy down here. Okay, so if someone places an order into the market, they buy the euro American dollar with a market order, and they have 50,000, let's say, it's just completely arbitrary number. Let's say they want to buy 50,000 units of euro American dollar. I know it's a weird example, but it's a hypothetical example. So they come in, they click their buy button, buy 50,000 units, boom. I mean, what happens? What happens here? Well, if they want to buy 50,000, that buy order is going it's going to consume this one, this one, this one, and this one, and this one. So it's actually going to change the price. So this order of 50,000 units is going to increase the price of the asset. And this is important, so please pay attention, because we're going to look at what this looked like on a price chart afterwards. Okay, but to the downside, if I want to sell 50,000 units, I put the market in here and the price doesn't move at all. Why? Because this is a discount price for this asset and there are willing buyers below price. So when I sell at the spot price, my order gets consumed by the willing buyers below, and so price doesn't move. It's just absorbed and nothing happens. Price doesn't move, and so my order gets filled, but price doesn't go further because there has to come much greater numbers of sellers in order to consume the liquidity just here. And currently the supply is low, and so the demand is supported. Okay, and so you'll see this. We'll look at an example in a minute. It's very interesting to see on a price chart. So if we look at this one here, okay, what's moving prices? Well, we have big demand, really big demand, as we looked at on the previous slide, is going to gobble up the supply because the orders available, liquidity available for sale above price are going to be smaller, and so my buy order is going to consume that liquidity. It's going to move through it quicker, and the same applies when price moves lower. And if we see this here, you can see that here we have the open of a period, here we have the close of a period, and then here we have some fictitious liquidity available at this. And so what will happen is, you can see we have the thicker market, which is below price, and the thinner market above price. And so what's going to happen naturally? Well, the buying that happens once price dips down into these thicker pools of liquidity, or once people start buying at market, these bigger orders, they're going to consume liquidity above price. And this is going to cause the price of the asset to increase. Okay, and this is very common in illiquid assets like the crypto example that we used just a minute ago. Okay, so this is something that you're going to see a lot in the market. So let's just have a look and see what that looks like on a price chart. Okay, so if we look at this, you can see that we had price came down to this price level and it left. I mean, it left very forcefully. We went down, we did not stay in the area long, and then we went up and we moved above these highs. That's telling us that we have thick liquidity here. So we have many willing buyers down here. We have big buying orders here. Still big. They get smaller and smaller as you go higher, and eventually, if we draw a curve, eventually it'll look like this, where you have thick. Actually, let's draw it like this, like we normally do, where you have something that looks like that, where you have a thick liquidity, and then it dries up and it goes like this. Okay, and the further you come to the end of a move, the thinner the liquidity. And if you use market profile, if you're looking at the depth of the market, you'll actually see the depth of the market. Normally, I mean, you have, let's say market profile, you have something like this, then it kind of goes out. We have thick liquidity, and it goes down, it goes like that. And sometimes it'll disappear, and there will be actually gaps in the liquidity here, and then you'll have a little bit up here. And at points like this, when price comes up to a point where there is no liquidity, it'll have to gap up. And so you'll see these gaps, where you have a candle here, and it'll close here, and then it'll open here, and then close here. Okay, and that's because there's no liquidity. And so in order to fill that order, we actually have to jump above prices in order to find the liquidity that's available that can fill these orders. And so price gaps up. Okay, and so when you see something like this, okay, where it gets thin to the point where it's non-existing, then all of a sudden it'll go out like that. So let me move this a little bit further down here so we got it. So it'll go like that, and all of a sudden it'll go like that. Okay, and this is because, I mean, this is a discount price and this is a premium price. Okay, and people don't want to pay premium prices for the asset. Okay, so the premium prices end here, just here. They don't want to pay this high of a price for whatever this is, and so the interest goes down. Okay, and the interest going down is this liquidity. okay, it goes down. So the interest is visible in the form of willing buying and selling, and that dries up right here. I mean, there is no buying. People are no longer buying. But because price is so high and liquidity is so thin on that side of the market, if price moves all the way up here, okay, what are we going to start to see? We're going to start to see an increase in selling interest. So there's going to be open interest to sell at these high prices at the point where liquidity has dried up. Okay, and so this is where the market flips from being buy oriented to sell oriented, which we can see up here. Okay, good. Well, I'm going to leave it to this in this video, and I'll see you in the next one. Thank you for watching.